Welcome, curious minds, to another deep dive from TalkTickers. Today, we're digging into the Range Resources second quarter 2025 earnings call. We'll be breaking down the key insights from their CEO, Dagnar, and CFO, Mark Skooky, looking at performance and their strategic direction.
Yeah, this is definitely an important one. It gives us a real sense of how a major player in natural gas and NGLs is navigating, the current market. Natural gas is still fundamental, obviously, but NGLs, natural gas liquids, they're playing a bigger and bigger role. So Range's call is kind of a window into how companies are adapting, maybe even thriving. And just before we jump in, it's worth mentioning, they started the call expressing sympathy for folks impacted by the flooding in Texas. A good reminder of the bigger picture.
Right, absolutely. Okay, so let's get to the headline numbers for Q2. Sounds like it was a pretty solid period for Range, operationally and financially speaking.
Oh, definitely. The numbers, they paint a picture of real discipline and, efficiency. So for Q2, their all-in capital spend came in at $154 million. And production-wise, they delivered a strong 2.2 BCF equivalent per day.
So hitting their targets there.
And then some. What's really interesting is their capital guidance for the full year. They're actually lowering the high end of that guidance down to $680 million. It was $650 to $690 million before.
Tightening the range downwards.
Exactly. And crucially, they're saying this won't change their planned operational activity at all.
Okay, hold on. Lowering the budget, but keeping the activity the same. What does that tell you?
It signals real capital efficiency gains. Right. They're essentially getting more bang for their buck, doing more with less, effectively, which is exactly what you want to see in this kind of industry.
Right.
And on top of that, their production guidance for the year, they're now expecting it to be above what they previously guided, with most of that outperformance expected towards the back end of the year, Q4.
So better well results or faster turnarounds, maybe?
Could be a combination of things, yeah. But definitely positive signals on the production front.
And how about shareholder returns? What did they do there in Q2?
Pretty active on that front, too. They bought back $53 million worth of shares in the quarter.
Okay.
Which brings the total for the first half of the year to $120 million in buybacks.
Significant.
Yeah. And they also paid out $21 million in dividends in Q2. So it's $43 million year to date for dividends. Plus, they paid off $66 million in maturing senior notes. So cleaning up the balance sheet, too.
Mm-hmm.
You add all that up, buybacks, dividends, debt pay down related to equity value, and they've returned about $646 million to equity holders just in the first half of the year.
Wow. And what percentage of their market cap is that, roughly?
It works out to around 7% of their current market cap, just in 6 months. So, yeah, they're serious about returning capital.
Okay, so that's the snapshot. Strong performance, efficient operations, good shareholder returns. Now let's unpack this a bit more. What were the real drivers behind these results, and what's the outlook looking like? It sounds like operational efficiency was a huge piece of the puzzle.
Absolutely. Their execution on the ground seems to have been, exceptional. Take drilling, the team set new program records. They averaged about 6,250 lateral feet drilled per day.
Per day. That sounds fast.
It is. That kind of speed translates directly into lower costs per well and, faster returns on that invested capital.
Makes sense.
And then on the completion side, the story's similar. They executed 812 frac stages with a single crew in the quarter. That's another company record for them, about 7% higher than their previous best.
So faster drilling and faster completions.
Exactly. It points to really good planning, logistics, the whole field execution piece running smoothly, gets wells online faster and cheaper.
And they managed all this while keeping costs in check. What about things like lease operating expenses, the day-to-day costs?
Yeah, impressively low. Their LOE held steady at just 11 cents per MCFE for the quarter.
That's very competitive, isn't it?
Yeah.
Extremely. Shows ongoing discipline there. And they're also thinking ahead, building inventory. They drilled, 284,000 lateral feet across 20 wells. That's an average of over 14,000 feet per well.
Long laterals.
Very. And this adds to their DUC inventory, drilled but uncompleted wells. They're on track to exit 2025 with over 400,000 feet of this inventory ready to go.
So that gives them flexibility, right, to complete wells when the timing or pricing is best.
Precisely. It's like having future production already teed up. And underpinning all this is their supply chain. They mentioned strong partnerships and contracts covering most of their key 2025 service needs already locked in. That helps manage costs and execution risk.
Okay, so the operational machine is clearly humming.
Yeah.
But what about the bigger picture, the financial strategy, the long-term vision? How are they leveraging this strength?
Right. This is where it gets really interesting, I think. Financially, they're in a great spot. They highlighted their strong balance sheet leverage is less than 1x.
Meaning their debt is less than their annual earnings, roughly. Exactly.
Yeah.
Based on EBITDA.
Yeah.
That low leverage gives them enormous flexibility.
Yeah.
They aren't forced into decisions just to manage debt. They can be truly strategic.
Okay.
And they confirmed their multi-year plan. They're aiming to grow production by about 20% through 2027, targeting around 2.6 BCF equivalent per day.
Mm-hmm.
And get this, they plan to do that while keeping annual CapEx under $700 million.
Wow. Growth, but very disciplined spending.
Highly capital efficient growth. That's the key takeaway. And they estimate that once they reach that 2.6 BCFE per day level, they can actually maintain it for less than $600 million a year in drilling and completion capital.
Just to keep production flat.
Yeah, which works out to about 60 cents per MCFE. That speaks to very low base decline rates for their assets. They don't have to drill frantically just to stand still.
Right, freeing up capital.
Exactly, which leads to cash flow. They're projecting free cash flow to exceed $2 billion, maybe even closer to $2.5 billion over the next 3 years through 2027.
And that's based on what kind of gas price assumption?
A pretty conservative $3.75 natural gas price. So there could be upside there.
And $2 to $2.5 billion? What is that relative to their market cap again?
It's nearly a quarter of their current market cap projected in free cash flow over just 3 years. It's a powerful number.
Definitely catches the eye. And I think you mentioned something about taxes helping the cash flow picture, too.
Yes, that was another positive update. Because of some changes in depreciation and R&D expense rules, they now expect to become a full cash taxpayer a year later than they thought.
So lower cash taxes in the near term.
Exactly. For 2025, they're projecting a low single-digit effective cash tax rate, then mid-single digits in 26, high single digits in 27, only hitting mid to high teens in 2028.
Okay, so that deferral means more cash stays in the company for longer.
Right, more cash available for operations, buybacks, dividends, whatever they choose. It makes those free cash flow projections even more potent for investors.
So putting it all together, the operational strength, the financial discipline, the cash flow, what does this mean in the broader market context? How does Range stack up competitively?
Well, they seem incredibly well positioned, especially given the demand trends we're seeing. There are significant tailwinds for both natural gas and NGLs right now. Natural gas storage, for example, finished Q2 down 6% compared to last year.
Okay.
And a big part of that is record LNG feed gas demand. We saw levels over 17 BCF per day in Q2. Global demand is pulling hard.
Right, the export market.
Huge factor.
Yeah.
And looking ahead, the U.S. market is expected to add something like 8.5 BCF per day of new demand over the next 18 months.
Right.
That's coming from more LNG exports, yes, but also pipeline expansions to Mexico. It's a significant demand pull.
And it's not just exports driving demand, is it? You mentioned Pennsylvania earlier.
Exactly. This is potentially huge. There's over $90 billion in new AI power and infrastructure investments announced just in Pennsylvania.
$90 billion. Wow.
Yeah. We're talking massive data centers, advanced manufacturing, things that need a lot of reliable power. And that puts Pennsylvania natural gas right at the center of powering this growth. It creates massive new in-basin demand.
Reducing the need to ship gas long distances.
Precisely. And this plays directly into Range's strengths.
How so? What makes them uniquely suited?
Well, they're one of the few producers in Appalachia with enough high-quality inventory measured in decades, not years, to credibly support these huge long-term supply needs.
The duration of their reserves.
Exactly. They have the longevity, these big industrial users, data centers. They need certainty of supply for decades. Range can offer that. They actually talked about their 5 nines reliability capability for long-term deals.
5 nines, so 99.999% uptime.
Essentially, yeah. That's the kind of guarantee these critical facilities need. They can't afford interruptions.
Right.
So Range is actively talking to these potential large customers, building on deals they've already done, like with Imperial Land Development. Being able to lock in long-term in-basin contracts is a huge competitive advantage versus just selling into the spot market.
Gotcha. Okay. Shifting slightly to NGLs, what's their play there?
Strategy there is pretty clear. Direct their LPGs, like propane and butane, towards the international export market, where pricing is generally better. And their key advantage is their East Coast export capability, specifically out of Marcus Hook near Philadelphia.
Access to Europe.
Right. It gives them quicker, cheaper access to European markets compared to Gulf Coast exports. And they said this delivered a 61 cents per barrel premium versus the index price in the quarter.
Nice little bonus.
Definitely adds up. And overall, U.S. ethane and LPG export capacity is set to grow significantly over the next year and a half, which should provide further support for NGL prices and more outlets for Range.
Okay, so they have this growth potential, strong assets. How are they managing the pace of that growth? Are they worried about flooding the market?
Management seem very focused on discipline here. They stress that any additional capital or production growth will be added opportunistically. Basically, only when they see a clear line of sight to demand that justifies it.
So not just drilling for the sake of volume growth.
Exactly. Trying to avoid contributing to oversupply in the basin. They see U.S. production hitting maybe 107 BCF per day by year end, but they feel the demand growth we talked about can absorb that. Their hedging strategy fits this too. They aim to hedge enough to cover fixed costs, protecting the downside. But they leave significant upside exposure because they believe the current forward prices don't fully reflect the strong underlying fundamentals.
Betting on higher prices down the road.
Essentially, yes, while protecting the base business.
And one more thing, sustainability. It comes up more and more. How's Range doing there?
They highlighted some significant achievements. They've reached net zero for their Scope 1 and 2 greenhouse gas emissions.
Net zero? How?
Through a combination of direct emissions reductions and using verified carbon offsets. They've also cut their methane emissions intensity by 83% over 5 years. And importantly, all their Pennsylvania assets have achieved an A-grade MIQ certification.
MIQ. Remind us what that is.
It's a third-party certification that validates low methane emissions intensity for natural gas production. And A-grade is the top tier.
So it proves their gas is produced with low emissions.
Exactly. Which can make it more attractive to buyers, especially those focused on ESG, and potentially fetch a premium price. It's becoming a strategic differentiator. They also mentioned optimism about permit reform at the federal level and support from Governor Shapiro in PA, potentially speeding up infrastructure projects, which helps everyone, but especially suppliers like Range.
Okay, this paints a pretty compelling picture. Strong operations, solid finances, unique assets, aligned with major demand trends. It really begs the question, if you were, say, a hedge fund analyst looking at all this, what kind of bold but still plausible trade idea might you pitch?
All right, let's put on the analyst hat for a moment. This is purely hypothetical, of course, not financial advice.
Understood.
But you can imagine pitching something like this to an investment committee.
Look, Range has this unique combination, decades of top-tier inventory in Appalachia, proven operational chops driving down costs, and they're right in the sweet spot for this massive new wave of in-basin demand from AI, data centers, industry customers needing guaranteed long-term supply.
Okay.
So an interesting way to play this isn't just buying the stock. Consider going a deep in the money, long-dated call option on Range. Maybe targeting a strike price that looks cheap relative to their projected free cash flow per share over the next 3-5 years, even using their conservative $3.75 gas assumption.
Using options for leverage on the upside. It's exactly. Leverage to their capital return story, especially the buybacks, reducing the share count, making that free cash flow per share grow even faster. The option magnifies that potential. Now, to hedge out some general energy market risk, you could pair this long call position with a tactical short position in a less diversified natural gas ETF, maybe one focused on a basin with higher costs or shorter inventory life.
Spread trade.
Right. The goal is to create a spread trade that captures Range's specific advantages, that a certainty of supply premium they can command, their ability to lock in potentially better pricing with these new demanding customers, allowing them to outperform peers stuck in the more volatile spot market. The thesis is basically betting that the market hasn't fully grasped Range's transformation into this super reliable, low-cost supplier for the new energy economy.
Interesting. Capturing the specific Range story while hedging broader market swings. Plausible is bold.
Plausible, yes. Definitely requires conviction in that specific thesis panning out. But to wrap it all up, the core takeaway from the call really is that Range Resources seems exceptionally well positioned. You've got the operational excellence, the strong financial management, that unique long-life asset base, and it all aligns really well with where energy demand seems to be heading, particularly that localized high-intensity demand.
A compelling story indeed. And just a reminder to everyone listening, this deep dive is purely for informational purposes. It is absolutely not financial advice. We hope this breakdown gives you plenty to think about regarding these long-term trends, AI's energy needs, the importance of reliable supply, regional demand shifts, and how companies like Range are positioning themselves. Thanks for joining us on TalkTickers for this deep dive. We'd love to hear your thoughts or questions for future discussions.